Welcome to another edition of the Grey Market Talk in lazy August. The last three videos on this channel I had pre-recorded, but they were also very, very interesting. Especially we hit the spot right on yield curve control in Japan. Briefly after us, everybody started talking about it. Maybe we weren't the first, but I think we had the nicest analysis. Especially, I'm very proud of the Ninja yield curve control.
Perfect.
Menomic we praised. So, and today we are in our seats again, and there is something interesting which I thought I have to discuss with Nick. Nick, where's my recession? Everything I was preaching for the last year, I've written it down actually. We had inflation, I saw that early, tick the box. We had Fed tightening at an enormous pace, at an enormous speed. We had quantitative tightening. We had a resulting profit squeeze out of that, which we can see in the market. We had regional banks blowing up to a bigger magnitude than in 2008 by assets under management. We had a debt ceiling fight where we all thought there is a small possibility that they're blowing the whole United States up. Now, Moody's has also reduced the rating of the United States. The Fed is now paying $1 trillion a year just to service their debt, not the Fed, the government. We have the mother of all yield curve inversions, and now we have even a bear steepener in the yield curve inversion, which we have always seen just before the S hits the van. That's what's happening. We still haven't got it. Yes, we've seen a small decline in Apple, but where is my thinking wrong, Nick? Or is it just a matter of time till it happens? And like a broken clock, I will be right at one point.
Well, I'm sure like a broken clock, you definitely will be right at one stage. But, it just goes to show that the classical approach of how to analyze markets and economies isn't always the way that kind of gets the two in sync. So what's going on with the economy is totally different from maybe what's going on in the markets. And the markets had this boost because of because of liquidity in the system. We talked about that before. And now the recession. Well, I mean, even the Atlanta Fed are now talking about 4% growth for the next quarter. So, there is no recession right now. And I always said, you're not going to get it, at least not now, because there's just too much money in the system. There's still too much money from COVID swilling around. And now there's, as the government are in such deficit, all of this Inflation Reduction Act and all of this stuff, you've got this government stimulus, which, has been souped up by the interest payments. That money is going into the system. So, there is still money in the system, and that's why there's no recession. Whether it comes, when it comes, how deep it is, different thing. We follow the markets, we follow prices.
You just mentioned the Inflation Reduction Act. Is the government actually blowing the money into the system the Fed desperately tries to take out to fight inflation?
Yeah, I mean that's I think that point's been made is that and actually that's not such a bad thing. Yeah, I mean sometimes that's the way it works when the government says we're going to spend a lot of money. The central bank should be saying, well, okay, we need to sort of tame it down a little bit. What happened in the year 2020 and 2021 was the exact opposite. In other words, the government spent a lot of money and the central bank spent a lot of money. So that was, that just kind of multiplied itself. But the government are acting in the other way to what the Fed are doing. And in fact, again, I think we mentioned this briefly before, when you raise interest rates on such an amount of debt and you throw 1 trillion a year extra, it was not very much earlier on, a few years ago. So now it's 1 trillion. So now you're putting 1 trillion into the system. Well, who actually decided that in government? Nobody. It was the decision of the Fed. So the Fed themselves are effectively also adding to their own problems. I mean, it's not just a government issue, is it, really?
So the problems are getting bigger, and that was a bit when we talked briefly before we press the record button. What we want to talk about is financial repression. The system or the model that is building, and not the model, the reality that is building up, which is not matching the models I'm employing here, will eventually lead to a burst or not if they do specific things. And we want to step into the specific measures that could happen in the market. And that would have an influence also on your asset allocation. Will we see something really bizarre, Or will we see how markets always used to work? That I'm wrong in the short term, but eventually I will get right. And I have a couple of slides for that, obviously, which I'm going to share now. And you tell me when you can see them on the screen, Nic.
I can see them.
All right. So these are the quite interesting slides for today. I wanted to start actually with a quote of Karl Valentin. He was a German comedian in, well, from 1920 till the end of the Second World War. Karl Valentin, today you would call it a stand-up comedian. And obviously, I read an article 35 years ago about him, and so I'm still getting the feeds. And I like this motto of today, wo alle dasselbe denken, wird nicht viel gedacht. When everybody thinks the same, there's not a lot of thinking going on. Yeah? And why do I like this guy? He was a brief excursus, because a little bit of history is always fun. He had a show before the war started, but the Third Reich was already in power. And he brought a pig to the stage and called it Hermann. Obviously, there was some person in the Third Reich, Hermann Göring, who was very upset about it. So he spent a night in jail, was eventually released, and everybody was waiting for his next show. And his next show, he brought the pig again on stage and said, well, I'm not saying his name, but because of this swine, I was in jail. So a man of profound humor, which I think in these markets you need, especially when I go to my next slide, which really made me laugh out loud. And maybe you can dip in actually what happened while we were on holiday. We see, for everybody who's just listening to it, we have a smiling Mrs. Lagarde in front of us saying, your banks, our profits.
Yes. Yeah, so I guess you're referring to the Italians here who put in a windfall tax. I think you've got your own theories of how clever that is actually for Italy. Maybe you want to share that.
I stole it actually from my wife. She said, do you know what's happening there? I said, well, yeah, typical. The Italians want to get money off their banks. And she said, no. Think it through. What was happening there? I said, okay, fine. They want to introduce a 40% windfall tax on the money they made with the interest rate differential they have. And she said, okay, fine. So you have a country which is technically broke and not in a good condition. Could they go to the German government and say, after all the subsidies we already passed on during Corona times, could I have a couple of more 100 millions or billions or whatever real money is? Nobody would accept that at all. So what's happening? The ECB is taking up the interest rates while the Italian government supports their own banks and say, fine, you don't have to have extra equity in here. Just take this extra money you make. And after you've taken in this extra money, we then simply tax it. So the money starts ending up in the coffers of the Ministry of Finance in Italy. It's still the German money coming over, but now they can say, Mrs. Meloni, who has the approach of being, well, populist or right-wing or whatever you want to call it, yeah, I took it off the evil bankers, and everybody's happy with that. In reality, they took it off the Germans, as usual, but nobody has seen it because it was a very, very clever transfer going on there. I thought a very interesting thought.
Well, this is interesting for the EU going forward. It's kind of every person for themselves, and you see that actually a little bit more and more with governments acting on their own. Germany having its own policies to support their economy, rightly in a way. The Italians doing the same thing, guaranteeing debts for corporates. I think it was a while ago they did some supporting loan for NL. And, this is, in the end of the day, money creation that's sort of being done circumventing the central bank. So it's everyone for themselves, except the ECB are kind of out of that game. And that's not really what the EU is supposed to be about. But in such difficult times, you can understand that.
We have seen that before. You remember 2009 windfall taxes in London, where I think they took 90% of our bonuses in 2009 after the financial crisis.
Right. Yeah.
It's one of these when the state suddenly starts getting really, really creative to get other people's money. And I was a partner in my bank. For me, it wasn't important anymore. I was out by then. But if the bank would have still been living, alive, and I was a partner with personal equity in this firm, and suddenly somebody says, well, you take the personal risk, Mr. Wegener, and if you have a bad year, we're not sending you a check. But if things are really running well and you've done a good job, let's not take 50% as we always usually do. Let's take 90% on top of that. What does that tell us about the state of the financial system we are in at the moment if governments are getting in so blatant?
They need the money.
Just asking for it, yeah? Give it to me.
They need the money.
Yeah.
All right. And, why do they need the money? At the end of the day, they want to give it to someone else.
Yeah, they have to finance, perfect segue. They have to finance a lot of green stuff. Yeah, there was an interesting, I think it's from the Welt, German newspaper. It's about the German Angst, who is most afraid from climate change worldwide. It's from May 23 this year. I might have had that before. So 16% of the world population are afraid of global change. And on number 2, every third German is apparently panicked about climate change. So if every third German is panicked about climate change, we definitely have to do something about it, right? How are we going to do that? My solution was very simple. Tell your wife and your children when they leave a room, switch the light off. That I don't have to do it, yeah? And we would have solved all our problems. But as these simple solutions do not fit, we have to obviously spend and reduce CO2, which makes plants grow massively. And Germany is the world leader in there. Then we have Singapore, Australia, France, Netherlands, Thailand, Spain. Surprisingly, the United States with 20% only in the midfield, and the clever Israelis with 2%, like the Argentinians. They don't really seem to think that that is a big issue. Why? Because I think Israel is a fantastic example. Everybody was talking always about water shortage. Israel is supplying 80 or 90%, I read, of their water out of desalination plants from the sea. There was nothing, and now there's a lot. They're exporting a lot of, citrus fruits, you name it, because they have solutions to problems which actually make sense. I thought that was very interesting because that segued us into who is still buying fossil fuels from Russia in 2023. And European Union has gone down massively. What it says, revenues from exports to the European Union have fallen by nearly 90% from the peak in March this year, which is interesting because that always asks me the question then, which I'm throwing in your direction again. Do we actually don't want that, or don't we need it? Because our economy already starts sucking the big one, and the guys who are doing the procurement trades know that.
Yeah, I mean, Germany needs energy. So people need energy. Industry needs energy. They'll get it wherever they can get it from. And, this says it's coming from Russia. I've also seen, the same kind of information that Russian energy is still finding its way to Germany, to the EU. They say it's not happening. Clearly is. But it's necessary, and the issue here is, who's still buying fossil fuels, and it says from Russia, but who's still buying fossil fuels? Absolutely everybody, and the consumption of and the demand for oil and the demand for coal is still, it's not declining, it's still on the up, and this we talked about it before. The notion of 2050 net zero is, it just doesn't seem realistic, frankly.
Well, especially if you look here at the chart, China is still the biggest buyer of Russian oil, and China is also the country with the biggest contribution to, let's call it, the pollution trade out there. And I found that very interesting because it reminded me when I was still in school in 1989. That was the last trip we did when the GDR, the DDR, was still alive. And we crossed the border at Erfurt, and you came in from a green, beautiful-looking country, West Germany, into a place which looked gray, smutty, dirty, rundown. The air smelled of coal. It was really terrific. Even then, nobody was talking about this. People were talking about air pollution, but you noticed that, and you saw all the buildings gray from the coal soot and everything that was going on. And I thought, that doesn't look good for socialist countries. And I stumbled across this, I don't know from which magazine I actually clipped that, but it's a slide which said, okay, let's use the OECD definitions of free, mostly free, moderately free, and how they are performing on the environmental scores. And the interesting thing is capitalist countries, which we are trying to, like Mrs. von der Leyen or Mrs. Meloni, are trying to tame a little bit into not being so capitalist countries anymore, always did the best for the environment. And the countries which are repressed suck the most. Yeah. So if we are going into a progression of repressed countries, repression by the state, there is less money to invest in nice to have things like saving the climate or making the world a little bit a better place. I found this slide very, very intriguing because it just confirms what I always thought. Yes, if you want to have a reduction in CO2 or make the world a better place, you should unleash the forces of capitalism to give us the money to blow it out, not just trying to, well, reduce the system's ability to generate that revenues to afford these measures we want to take. Anyway, I'm going again in the political field, Nic. I didn't want to do that, but it's.
I know, but you know, coming back to the previous slide on you know, who buys Russian oil, you know, if it's not bought by Europe, it'll be bought by someone else. And I mean, that's just the way it is. And so Europe then, instead of buying Russian oil, it goes and buys LNG or wherever from the States. You know, we need the energy. So that's it, full stop. And that will continue. And where we buy our LNG, the person who was previously going to be buying that LNG probably says, okay, I'll better use some coal instead. You know, what we were doing is just, in a way, just playing a game of, you know, moving the shells around, but there is no reduction in any way. You can't afford to reduce. You have to continue to, you know, to run your economy. And so it's kind of irrelevant whether EU buy it because somebody else will buy it instead.
I'm with you. By the way, the next slide I have in Greece. Greece is just the opener for the next slide, but I found that actually quite interesting because obviously since 2007-8, I was a big fan looking at Greek bonds and how to trade them, extract value out of them, and was a big fun ride to do that. And we've now actually out of the woods again. Yeah, Greece is doing fine. Nic, is that true?
Hola, wonderful. I mean, it's a great thing. Well, clearly, I mean, I remember a few weeks ago you showed me it was a clipping from I don't know if it was LinkedIn or Financial Times or both or whatever, saying hedge funds are short of Greek debt, and I kind of said nothing to see here. You know, I guess relatively it is expensive versus things like Italy or whatever, but you know, there was really nothing to see here, at least nothing at the time. I mean, if they focus on stuff like that, they're looking in the wrong place for trades. But yeah, I mean, clearly, the eyes are not on Greece. The eyes are on the Americans. I mean, you know, we talk about Greece here coming out of the problem zone, and we also had this week. You said Moody's, but I think it was Fitch who downgraded the state. So that's really where we should be looking.
Well, absolutely. For me, it was more an indicator about the political situation because the topic, which is the overall consuming, yeah, we have in this conversation, the bond market or the rating agencies or both are signaling to us Greece is not going to default ever because that would be the bloodbath starting on the outskirts. And now the market says, no, it's not going to happen. If Greece falls, then Italy falls, then Spain falls, then France falls, then the whole game is over. So we're now more confident, whatever the Greeks are doing, it ain't going to happen. It might be a good investment. We're 8 levels above junk, apparently, which is very interesting because, yes, United States has now got was it the 3rd downgrade? I think Moody's was the first around 2009, 2010. And
11, I think.
Yeah. And now Fitch came out, said United
States. Was it S&P the first? Was it S&P? I can't remember, to be honest with you. It's been
not the top dog anymore, which I think, well, as long as they're reserve currency, I think it's bloody foolish to say they're not AAA anymore. What's the whole point? The whole point is, will you be able to pay it back? They're not going into inflation there. They're not going into purchasing power parity of the whole thing. It's about the credit quality of the provider. They are the guys who can print the money. They are the guys who can raise the taxes. They will always be able to pay back what you can buy with it. It's on a different question. But as a rating agency to come out and say, oh, no, we don't see that anymore, I don't really see the point, as you always say. Anyway, but that was just the segue to go into China, and that's from the Financial Times. And I thought that was very, very interesting because we discussed that quite a couple of times earlier. And on the left slide, you have Chinese consumer price slips into deflation, signaling weak demand. I mentioned Richard Koo 2, 3, 4 weeks ago.
Yeah, we talked about this a long time ago about China being in deflation.
Yeah. Who said he's been hired a lot recently as advisor by the Japanese government to teach them about a balance sheet recession. And a balance sheet recession, just to repeat that, is if interest rates eventually are coming down, but corporates are not taking this money and investing it in something productive, they reduce debt whenever they can. Something Japan was suffering for a long, long time. And Richard Koo was the man who actually wrote the book about this. It's a good read if you're inclined to read that kind of books. And China core inflation on the right ticks up, but remains far lower than that of the peers. So what is the implication for the world economy? I'm still asking for my bloody recession. If the Chinese, the workbench of the world, are getting into a pickle here, and I think that's what we are seeing. Yes, they have a government which controls every aspect of the economy, but if people stop buying in China and are not building or buying new apartments anymore, they have a problem, and that will have implications of the world economy, especially if Europe also skips out of the game because Germany is sucking the big one. Will I get my mega depression?
Well, the Chinese, we talked about this also being in deflation. We talked about it before the press, I think, got hold of China is in deflation. Yeah, they had this big property, explosion, boom, bust cycle. And last year, they had, most large amounts of their debt was just worthless, frankly, and the Chinese have done their best to kind of paper over the cracks, but this is a big crack to paper over, so this is not something that goes away lightly. And on top of that, the Chinese also had this ideological view that houses are not for investment, they are for living in, which a statement which they recently dropped, which gave people some hope that they're going to do something about the real estate market. But what do you do when you get a deflation? When you get asset prices collapsing like this, you have to throw in a lot of liquidity, or at least that's the playbook for central banks, and they've been doing that. But they have half an eye on their currency. Now, normally you would throw in the liquidity and say, whatever happens to the currency, don't care. But of course, they've got a BRICS meeting in a couple of weeks' time, and they do not want their currency to fall out of bed, because their currency may play some role in what they decide at the BRICS. So they do want in the short term to support their currency. Maybe they let that go afterwards because they really do need to fix their economy. And if they don't fix their economy, obviously there are consequences, around the globe. China is not an unimportant economy around the world, and so therefore, if they continue to go under, then that won't be good for the rest of the world.
Yeah, well, we discussed that as well. On the 22nd of August in Joburg in South Africa is the BRICS meeting about their gold-covered currency. And you heard me saying it here first. If they actually implement a settlement bank in Switzerland, which will provide you with the gold for the paper, then that's that for the dollar. It's over the game. They're not going to do that because they're not, clever or brave enough, because they would surrender influence over this artificial new currency, which would make it a real currency if they don't have any influence over it. So it will be a stillborn child is the right word, because they're not surrendering that one thing that could make it a real competitor in the world market. But yes, that could be, again, one of these little catalysts to give us a surprise in the markets to come. And that would lead me actually to, that's what I found quite interesting, the market cycle guidebook here. It's from top-down charts. I like their charts. They are precise, quick, concise. And all what I've already mentioned in the intro, leading indicators, soft data, hard data, and inflation point into a really, horrible future, I would simply call it. Especially now, China is not playing the game. Europe is making new highs in the DAX for what's pizza delivery companies, or I'm not getting it anymore. I grew up in the time where we actually produced shit, real good stuff the world wanted to buy, and now we have pizza delivery companies in the lead index.
Oh, anyway. Services, right? Service industries today are taking over, and the thing about service industries is that it's a very, very low multiplier effect on the rest of the economy, whereas manufacturing and this kind of activity actually goes from one company to the other, to the other, to the other. And that's kind of explains in a way why growth has been slowly, how should we say, on average, coming down as opposed to sort of going up. Over time. It's not just a huge amount of debt, it's the type of businesses we run.
And also leads you in a low quality economy. Yeah, you need 3 clever guys who can program an app, and the rest is guys on motorcycles delivering your food to your door. It's not like hundreds of engineers at Siemens producing the latest turbine which will power the world.
Sure, absolutely right. I mean, we talked about, all the money that's being spent, all the debt that is in the world right now. We would rather these deficits being, created because we are investing in looking for a cure for cancer, investing in looking for, better energy sources, investing in the future instead of just, either doing things which allow us to put our feet up and do nothing, or alternatively just putting, bribing voters to vote for somebody at the next election.
So let's go into the history of it all. That is a very interesting slide. Where did I rip that from? Well, thank you to all the people of LinkedIn and Twitter who are sending that stuff to me. Obviously, they want me to see it and to use it. So that's what I'm doing here. If I forgot to mention somebody, I'm very, very sorry. But hey, if you keep sending that stuff, I'm going to use it because it's interesting. And that's the historic survey. Today, the 10 largest firms account for 1/5 of the market capitalization in the United States. And what the chart tells us is actually whenever the market had a frenzy about a topic, a narrative, then that seemed to be exploding. And the market after that had for a very long time slim pickings in these specific sectors. We had in the 70s the US blue chips, big frenzy. We had in the 80s the global oil majors. We had in the 90s Japanese financial markets, where I lost the first time decent money. 2000 the internet origins, and now apparently we have 2023 AI onset, which could save the world or not, or the valuations are already too high and the market now takes a couple of years actually to catch up to what we see in these forecasts, in these predictions we can see here. I thought that was very interesting to keep the historic relation or historical relationship in there, because that is leading me actually to the point where you're a bit of an expert, which I wanted to make. If everything or maybe the zombie apocalypse first, and then we come to the main point of this conversation, because that is quite an interesting chart. Aptly named. I'm going through here. No, I can't see it on the left. Wait a second. Where are they? I had them in here. Have they disappeared? No.
I think
what I want to show is actually
there we got it. Wasn't it or not?
The zombie apocalypse. Yeah, that is something obviously I have discussed with Nic here also quite a bit. If there is a blow coming from, where is it coming from? And you just go through the back catalog of the weeks back, it will come from the corporate side. Yeah, where will it come from? The corporate side, from the so-called zombie companies. And I saw this chart. It simply shows us from 1990 until present time, which companies out of the Russell 3000 would not be able to service their debt out of their operating revenues. And I thought that was actually, if you look at this chart, you know something is coming, something big is coming. And if it's coming, it will be an absolute bloody nightmare. If you look at the HYG, I don't have the chart here at the moment, we're almost at levels of 2008, HYG being the high yields. So what happened at that time, Nic? The market obviously imploded. Spreads blew out by over 1,000 basis points, more even. Yeah, market froze completely together. We are already at these levels, not exactly, but the market is already indicating us we are in a bit of a pickle, especially if we look at the zombie apocalypse building up here. And this chart was so impressive to me that I thought, okay, what actually can I make out of it? Obviously, I could put all my money in gold and go home, or what is a game plan for the economy? What could our politicians do? What could our central banks do to still save the world? Because that is a bit of a topic you have going on since we started being on air, where you said there are bad things about to happen. Because they are about to happen, they will not happen, they can't happen, and that is what governments will do. And that's where I made the segue again to financial repression. Nic, explain to me first, what do you mean with financial repression, and how is that going to save the world?
I was just still pondering over your slide here. I will talk about financial repression, but you had two slides. One, you had Apple, top of the world, and you got some zombie companies. And one thing I said a couple of weeks back as well was, if I was Apple, I would be, with 3 trillion valuation, I'd be buying as many small companies that made sense as I possibly could using a share exchange. So what does that mean? I would therefore sell Apple stock and buy IWM or something like this. I actually still quite fancy that trade. And there you go. Look at that. That makes a lot of sense. Why are people buying Apple? Because it's in an index, right?
They have to.
Because, it's in this index, it's in that index, and, God knows whatever else. And so, but if you look at the underlying, the rate of growth of earnings of Apple is somewhere in that history was the peak. And it just can't go at that rate
anymore. But it's actually it's declining for the last 3 quarters in terms of revenue. What Apple is doing there.
So right, so that's the point you're making, and effectively you're saying, well, hang on, let's look back last 3 quarters, and that takes us back. And the price of Apple there was, if Apple was worth 2 trillion today, you'd say, yeah, it's about right. But it's 3 trillion. So what are we doing here? And therefore, if you were an owner of Apple, you'd probably say, well, I'd sell Apple and go and buy some small companies, not a zombie company, small company, but one that kind of makes sense, because the value stocks, the things that have been kind of forgotten about, and you basically say, well, I'm sure over time that trade will actually make sense. And
let me show you who buys Apple. Apple buys Apple.
There you go.
That's a fantastic chart. Valerie Noel from Cis Group, head of trading, posted that on LinkedIn. Thanks again. It's from White Charts, and it simply shows the Apple shares outstanding in massive decline since 2012. And you see the Apple buybacks, and Apple bought back 588 billion. That's half a trillion, over half a trillion in their own stock over the last 10 years. And that's more than 492 companies of the S&P 500. And these are always beautiful charts because they explain you why things happen in the past. And if we look at them today, does Apple, at a high interest rate environment with declining revenues, still has the financial powder to keep going, buying their own shares?
Yeah, I mean, that's the thing. It probably does. Is that a good thing? Is that a bad thing? Don't know. But does Apple offer value versus the rest of the stock market? I'd say that's a big question mark. And I'd rather, if you owned Apple, I'm sure there's a better place to put your money in the stock market. But people buy Apple because it's in an index, and of course Warren Buffett owns. I think he still owns 40% of his holding is Apple. I'm not 100% sure, but. He's taken advantage of that, and I can't honestly believe he's buying it because it's the best run company on the planet. I think it's just, he also understands the value of flow.
Yeah, they produce cash flow. I think it's very simple. It's the old Buffett model. Yeah? He understands the product. They have a moat around them, and they produce cash flow, and everybody has to hold them they don't
that
have.
has to hold them is the
Yeah.
flow that I was thinking about.
Yeah.
But I mean, of course, they do make, they do make have a great cash flow. But the flow of funds into Apple is just, it takes the value from 2 trillion to 3 trillion. We'd say, 2 trillion is about right. I mean, what do I know? But the point is, I don't think anyone would say, oh, it's totally undervalued at 2 trillion. It's just, anyway.
No, I'm 100% with you on that. It is an interesting point, especially after the last current dive. If Joe Retail and everybody who loves charts takes that as a decision-making point, they would have bought, and then they would have been badly surprised. And again, I did my own chart work. We could see 172, 170 again, but it's again this bloody you fill the gap. It was amazing to see that, how chart technical considerations seem to have worked at that point. So we filled the gap. We see here at this level when the earnings came out, and fine. It is a bit of the question marks hovering over the whole market, especially now with Nvidia's coming out with next week. So that will be a big point. So we are now in a region where we have finally reached, yes, interest rates are very high. Companies are still running on money they borrowed when money was cheap. Profits are falling at the moment. I think we're at a peak of 14-15% of profit margins, and long-term average is somewhere between 8 or 9%. So that would mean, if we have a mean reversion somewhere in the universe going on, if profit margins would normalize to the average value of 9%, you have another big bloodbath on your hand with all the high valuations we see in the market. If this scenario happens now, Nic, and I'm going to switch off the charts because that is the part I was deeply thinking about, and I thought I have to ask you about it. What is going to happen? Companies are in a scenario where they actually are not allowed to fail, because then the economy will fail, the tax incomes will go down, the state will not be able to finance itself anymore. So you have the mother of all crashes there, a real depression for 10, 15 years going on. 1929 will look like nothing against it. If that can't happen, then tell me why it can't happen, what they're going to do to not make it happen. And if we know that, where do I want to be invested?
Yeah, so basically that's the kind of thought process over the last few years, is that, the amount of debt out there for sovereigns who, since the global financial crisis, they took on basically all of the problems of the world on themselves. But in return, they took a little bit of control as well, and they introduced a lot of legislation and regulation and all of this stuff to make them able to do even more things. But you see, whenever there's a problem, what do? The gilt crisis, what did they do? They came in, they said, oh, we have to save the system. COVID, what do? They came in, they saved the system. They didn't say, right, everyone has to pay more tax. And they don't do that anymore. That game is, I won't say over, but it's very difficult to kind of play that game, because at the end of the day, if you take, tax, you're not going to help growth. Perhaps tax receipts, not, you earn more as a percent, you earn less as a total return. They're not playing that game at all. They are playing simply the game to say, we need the system to run as long as possible. We have a huge amount of debt that needs refinancing. And how do we keep the system going? So the first thing that has to be supported is the government bond market, because that's the kind of the oil to the financial system. It's the thing that provides also all of the collateral for loans and things like this. It allows the economy to continue to function, allows the government to continue to function. So the first thing they have to protect is the bond market. And what does that mean? It means that when gilt yields go up to 4 and whatever it was, sharply, they come in and say, well, that's not going to happen. We're going to stop that. When you had that repo crisis in 2019, they say, well, it's not going to happen. We've got to stop that as well. And so, the governments are kind of backed in a corner. The reality is that they can't let the system go down. They need the tax receipts from the system to keep going. But now we know that the tax receipts themselves, which let's just say in America, it's roughly let's say 18% there or thereabouts of GDP, tax receipts. And then their outgoings are something like 21%. So they have about 3% deficit. But you've got to add to that the interest now. So on top of the three and a bit percent, you add on the interest. And the interest is about 2% of GDP. It was last year. It's now a lot more. And going forward to 2053, the Congressional Budget Office forecasts that with interest that the annual debt to GDP will be 10%. 10% annual debt to GDP with an estimate of GDP, if my memory serves me right, what was in the report, was something like 80 trillion. It's a huge number, but 8 trillion a year is deficit. So actually you're having to print money anyway from now on just to pay the interest before you think about your deficit. So you're having to print money to pay the interest. Well, who does that? That's the emerging markets. So it's not an emerging market because it's the the dollar-backed system that we all have, and so financial repression comes in. What is financial repression? Financial repression is basically where governments use the private sector to kind of fund their debts in a way and or make their debts more sustainable. And the Japanese have been doing it for years, whether it's yield curve control, whether it's keeping interest rates very low with a very high government debt. And who loses out on that? The people who lose out is at times when inflation is higher than the interest that you earn. And in America, for example, currently it's the opposite way around. Currently you have real yields of 2%, I think, or thereabout for 10 years and 30 years. So in other words, that the interest rate that they are paying is 2% higher than where, where the inflation is higher the inflation is lower than where the interest rate that they are charging. And so that is an unsustainable state. Having interest rates higher than inflation is an unsustainable state. Obviously, they're doing it because they think that they can tame demand and therefore inflation will go down and then they can reduce interest rates. And inflation is bad for the poor people at the end of the day, more so than the rich people. So the game of financial repression is really about somebody at some stage, and it's clearly not happening now because the Americans are in the exact reverse situation now. They have too high interest rates versus where inflation is today. So they say, well, we're going to have to actually get the interest rates below the level of inflation so that our debt is sustainable. Because if they don't, then this debt bubble just continues to climb and somebody has to finance that stuff, right? And here's the thing. There was a report in Gold We Trust report from Incrementum, and it showed the debt profile of every country, Austria, Germany, France, UK, US. And US, it basically said something like 40% of the debt is below 2 years. Well, if 40% is below 2 years, and let's just say you've got treasuries of 25 trillion, so 40% of 25 trillion has to be refinanced over the next 2 years, and that's an awful lot of trillions. And who finances all of that? So, on top of that,
let me ask you a question there, because especially now, Mrs. Yellen, if she can't finance herself anymore on the short side of on the short-term interest rates, then she has to go wider out. That will have huge impacts on long-term bond investments out
clearly
there. And what we have seen over the last week, 10 days actually was pretty much this, what the market already read and said, oh my god, that's going to happen. And the market forces are stronger at the long end than they are at the short end. So is the solution to this whole problem, I can't raise taxes any further? A couple of years ago I submitted an article to the FAZ in Frankfurt, which they turned down, because it made the calculation, I don't know why they turned it down, probably my writing was crap in German, but it made the calculation, average Joe in Germany with an average salary, what is he or she paying in taxes? And I included every additional benefits you have to pay for, plus after you take in your tax money, what do you have in additional taxes? VAT, tobacco taxes, you name it, yeah? Under the assumption that you consume mostly everything of what you have. And I came out with a number which even shocked me, that from €1 you have 22 cents net. So we are very close to slavery. The only difference is they don't force you to work yet. But that's the difference. I think slaves could keep more of their take-home pay if there was something like that. Anyway, made as it be, if they can't suck that funnel dry anymore, they have to tell then corporates to get in, and you have to buy the long-term stuff because we tell you to. That still will not be enough, but they have to finance their huge debt. Are they then willing to take, social disruptions into consideration to say, yes, fine, we tell you interest rates are at 1%, even we know inflation is at 7%, but what are you going to do? We're the only ones who are telling where interest rates are. And fine, it's your problem, not my problem anymore. When is the system then blowing up, Nic?
Well, the system blows up when everyone realizes what's going on. And I don't think really people will realize what's going on. I mean, this topic of debt, everyone went haywire when Fitch did something, and from AAA to AA plus or whatever it was, yeah. They did one notch downgrade. This is not on the radar of many people, from many ordinary people, to truly understand what a debt bubble is being, they're all being diverted on, whether it's climate change or other issues like this. The bottom line is that the system is extremely fragile. And that's the problem when you've funneled all the debts into the sovereign. Somewhere you have to keep the thing going. So if you can't, and this is really where the debate is. Okay, so how does the government finance all of this stuff? So in America, they've got this big deficit. The central bank is saying we're doing QT, so we're reducing our balance sheet. We're not financing the debt that is out there, and we want China to carry on funding it. Well, they're not doing that anymore because they've upset them, and so there's geopolitically, Japan isn't doing it because actually their hedging costs are too much, and more likely they're going to repatriate that money back to Japan eventually over time. But it's going to happen most likely, and that's going to have implications. So there you go. That's two of the largest foreign supporters, if you like, of the US system, who are now they're not there anymore. So where does the money come from? Well, so then they say, okay, I've got a great idea. Let's force regulatory-wise the pension funds, the insurance companies, the banks, that they must all load their books of our stuff, of our debt. And the problem when they do that is that if you buy something here, you need the money to buy it. So you can't have this thing over there. So what is it that you don't buy it? Probably don't buy equities, probably don't buy maybe corporate bonds, or you don't buy foreign bonds, or you don't buy this, or you don't buy that. This is where the crowding out problem comes when you flood the system with so much debt. So I don't doubt that they will introduce legislation to force some kind of investments in this debt by the institutional investors. But I do have a problem in that I think that this just causes just too much indigestion. So there has to be a big chunk that has to be taken up by the central bank. So the Fed will have to eat up the rest.
Didn't the ECB try something like that with their green bond initiative? I think 1.5, 2 years ago, where they said, okay, we only repurchase bonds which have a green mandate or something, or in some scoring system will be beneficial. That is not the state or the ECB then financing green initiatives, but they just say, well, if you want to have a buyer of last resort, we only buy this green stuff. So that is clearly already going that direction.
Well, it is, but then they are effectively saying we will buy this stuff, but if there's no green, tell me what is green about US debt. So if the Fed came up with that kind of language, what would they be buying? I really wouldn't know what they'd be buying. But the point is that this debt pile is like your valuation of Nvidia. You say to me, Nick, if you look at Nvidia versus sales, Nvidia price versus sales, that looks really expensive. And I'd say, okay, I'll throw one back at you. if you look at the amount of debt in America versus GDP, it looks really high. So, we're both right, but, something has to trigger. And a one mini notch downgrade by Fitch caused all sorts of a hoo-ha. And then I was like, even you said, it's not important. Well, it is important. And the reason it's important, and Fitch actually made the point in their, why they did it. What they said was, actually, we discussed that very issue. I said that if I was advising a foreign investor, the fact that these people are even discussing defaulting on their debt means that I would sell their debt. And, if you are a rating agency, you need to react to something like that. And they did. Good luck to them. And what they didn't do properly was they didn't drop it down even more. As a real warning, maybe this thing was political. Maybe one political party just said to Fitch, hey, you know what, do it at one notch, then at least we get some consensus in the House that we don't argue anymore about budget deficit. We just don't know what's going on behind the scenes. But the reality is the debt situation looks unsustainable, a bit like your Nvidia valuation, looks unsustainable, Apple at 3 trillion, but there has to be a trigger to say we are going to do something about it. Only the Japanese have actually been doing something about it for the last 30 years. And it just goes to show you that if it's taken the Japanese so long and their debt to GDP is still so bloody high, then how long is it going to take the Western world to kind of follow the same kind of path? And that just means that I can't believe that interest rates will be higher for longer nonsense. Interest rates higher for longer is, you might as well just, phone up Fitch and say, let's just forget all of this analysis stuff and go, guilty, take me to jail. Because it's just not affordable. It's just not feasible. And, we're going to, I know there are analysts and, people who say interest rates should be 8%. Good luck with that one. Because when you are a politician, and this was the thing, and I put it out to my one of my clients this week. I said, from the CBO report, it was, the heading was something like interest being paid to foreigners. So not only do they want foreigners to buy their debt, but then they put in bold, actually, this part of this trillion that we're spending is actually going to go to foreigners. What that means is your 1.8% of GDP that you're earning is going partly to, fund, or the tax on the GDP is going partly to the foreign world. It's not even coming to us to pay off the defense or all of this. It becomes political at some point. It hasn't done in the Western world, but it will do. I understand in the UK, they are doing their best to try and also support their debt market. And I heard a report, I think it was also from Russell Napier, I'm not 100% sure, who basically said that the UK have come out with, the UK government, Conservatives, have come out with, they wouldn't be averse to the pension funds or your pension fund, defined contribution fund, as having to buy government debt. And the Labour Party, the opposition, who are likely to be in power very soon, have said, we'll probably do the same thing as well. So you can see that already people are discussing and thinking about how they will financially repress investors in the future. And what does it mean for asset allocation? So to finish off, that would have been my
next question, because they're loading up let's call it the poor fellow on the street in his pension fund now with crap, where they know we actually have a problem. We are not ever being able to repay it in purchasing power parity anyway. So let's front load them with, now I want to be the clever guy. Where do I put my money? One of the thoughts, I think we discussed that last week. If you have financial repression in this system, and I came about it by pure chance, because this chart I showed on the Japanese yield curve control was going into debt levels, and there were, again, our beautiful little countries who already had been broke, where there is not a lot of public debt, where there is, actually, you can't steal from somebody who hasn't got anything. So would I, as clever investor, and I say, fine, they have already been robbed by their guys before. There is not much more left So they have rock bottom. If there's any growth, there is not a huge danger to financial repression. That's where I want to send my money to before it gets stolen.
So that's been how my thought process has been. Obviously, it's far too early because we don't have the explosions yet, in the debt thing in the West. But it's, if you wanted to look at where's the long-term growth in the world, right? It's not going to be in the Western world, in my view. It's going to be in the smaller countries. It's going to be in Africa. It's going to be in emerging markets. It's going to be in Asia. It's going to be in Latin America. And America may be able to survive all of this thing because at the end of the day, as I said, the two things you need to survive is food and energy. And the good thing about America is actually they got both. The problem is they've got this bloody debt that they need to solve somehow. Whereas the rest of the world, they've also got a huge ton of debt. The Europeans especially, they don't have any energy and they don't have much food. So, that's really the problem. So if you're European anywhere else, right, and preference leaning towards where the future growth of the world is likely to be, because having so much debt in America probably depresses growth. So the future growth, and especially where given geopolitics, it's somewhere east, it's somewhere emerging, but it's certainly, I'm not a fan of the kind of the European story right now. At least they haven't sold me on a European story today.
It's you mentioned two very important points: food and energy. Yeah? And I'm adding on the third one, education. I think that is where you will see it coming. If one of these emerging countries, which has low debt, has a reasonable amount of food, has a reasonable amount of energy in their ground, wherever you might find it, Latin America or Africa, and if you can see education going up, then you have your future investment scenario. I'm with you. I think Europe and the Western world, maybe not America, is gone pretty much, because we're destroying this at the moment. But this would be, for me, the outlook to say, where do they something to their education? If you have a country like, let's say, Brazil or Nigeria, where suddenly the education level goes up, bloody hell, they're in for a real bonanza there. So that would be, well, my long-term outlook, what I'm looking for at the moment, education.
Yes. So then the next thing that's important to watch for is capital control. So the other thing that I think Russell Napier, and I mean, he really is the expert on stuff like this. You don't get financial repression without capital controls. And, what that means is if they want to force people in, down a funnel of you got to go and buy this stuff, what they don't want to do is to give you an escape valve and say, well, you can go and buy Bitcoin or go and buy. So it could well be that they start to prevent people from going into other markets. I mean, the hope is that, the crypto market is just far too tiny to even make a dot on anything. And the gold market as well is far too tiny. And you know what? The BRICS probably don't even care what the Americans do or the Brits do on gold, so they'll do their own thing on gold. We'll find out in the next 10 days or so what they've decided. But capital controls, is something to watch for.
Maybe that is where we can close on. If the guys are clever in South Africa, in Johannesburg, they might have listened to this podcast and my brilliant idea of giving an international settlement bank in Switzerland with total independent control. Then they might have a case for their dollar commodity linked currency, which will completely mess up the markets. Absolutely fascinating what's going to happen there. But I think that gave me a lot of food for thought, what we discussed today, because it is this situation. I know something is cooking here. We all know that. You mentioned Cyprus, capital controls. No, you didn't mention. I mentioned Cyprus. You mentioned capital controls. I'm pretty sure you had accounts, houses, yachts in Cyprus when they introduced capital control. How did you, as an individual, react to that, Nic?
I don't have. It's very nice of you to say so. But
okay, well,
that's an interesting thing. But money always finds its way out, right? I mean, who are the people with the most capital controls? China.
Yeah.
Look at what's happening. I mean, the money still leaks. They can't, this is like, they try and plug this and then they got to plug that. And then they say, hang on a minute, I've got to plug that as well. It's just too many. People find a way. And it's not easy. Or you just sort of get up and move home with your 24 words on Bitcoin and say, well, I'm going to start somewhere else and hope they don't do the same over here. But I mean, why should they? Yeah.
So we are in a scenario where we are just as Goethe again. Da stehe ich nun, ich armer Tor, und bin so klug als wie zuvor. I don't know how to translate it into English, but it just means after all this studying I've done, I know exactly as much as I knew before. We know something is weird. Yeah, something is in the system.
Absolutely.
The Japanese did show for me you can actually control a market into a controlled free fall, if that is the right word.
Yeah.
They've done over 30 years. It's all going for the direction of maybe a lost decade, but I wanted to today not give the last word to you, but I wanted to give it to baby Yoda, because I started with a meme, I shall end with a meme. It's for people who can't see that. It's a pizza box, probably in America, which said, open box before eating pizza, printed on it. And baby Yoda is looking at it and simply saying, we're not going to make it, are we? And that is how I feel sometimes at the moment. Nic, I want to thank you very much for this very enlightening talk. I really enjoyed that. It just shows that it makes a lot of fun and sense to talk about these overwhelming topics, these themes, which will guide us to the future. Do you have, after Yoda, anything else to say?
No, I'm sure Yoda would have said it in other words, like, not going to make it, we are.
Well done. Thank you very much for watching us. Like, subscribe, share. It is actually, the statistics show we are now picking up subscribers. Interesting. We just had to do 14 or 15 shows, Nic, and suddenly people are coming in, wanting to see us further. I like that. So thank you very much for being our guest today, and we'll see you next Sunday. Bye-bye.
See you. Bye-bye.